G'day guys, welcome back to Mango Invest. In this video, what we're going to do is break down a likely, good or bad dividend paying company being Packaging Corporation of America. A couple of videos ago, I did one about KeyCorp Bank, and with the banking crisis that happened with Silicon Valley, there was a reduction in the stock prices of all the banks. And then what we found was we done a little bit of analysis into the company, and it actually turned out that it was actually a very good, profitable bank that had some really good fundamentals here. So we're going to do the same with Packaging Corporation of America. On macro trends, there's a top 100 dividend stock paying companies within the website. So what I'm going to do over the next couple of weeks is just pick one, do my own sort of analysis, and come up to see whether that would be a good dividend paying company for the dividend investors out there. But we'll just have this is just a very basic sort of company. Deals with all sort of packaging, from shipping containers, e-commerce, but also promotional products for your retail outlets and other things to that sort of nature. We have seen a massive increase into the amount of entrepreneurs, people who want to run their own sort of businesses that require their own packaging. And things like Amazon were moving to a more sort of online e-commerce sort of environment out there. Okay, so what we want to get into firstly is just the finances of the company before we then get into all the dividend history and all that sort of stuff. So looking on an annual basis, we're looking at the income statement first, and we're just going to have a quick look at the revenue. And you can see at the graph here that it's got a nice consistent growth with the revenue over time. We look down to the gross profit, and you saw, it's like a nice linear progression there, but in 2020, obviously, when the pandemic hit, they sort of had a bit of a reduction there, but I think that's quite understandable for the packaging companies. Moving down to the net income, again, you see the 2020 a heavy reduction there, but I think, overall looking at it now, it doesn't actually look too bad. Okay, it looks sort of like a very steady company, and there's nothing of concern there. So looking at the balance sheet here, the cash on hand, okay, we've had a spike in 2020 with the cash. Right, another sort of reduction going back down to the 2018 sort of level there. Let's have a look down to the assets. So we've got $8 billion worth of assets. All right, so with a reduction in the cash on hand, that's their cue to then buy more assets. So as you can see, they're a nice linear progression, so very good signs there. And the liabilities is half of what the assets is, so it's only $4 billion there, so that's a good sign. Always having more assets than your liabilities, it's always a good indicator there. Right, so the liabilities isn't increasing as fast as what the assets are increasing, which is a really good sign. And moving over to the cash flow statement. Okay, so looking down at the cash flow from operating activities, we've got sort of very, very steady increases there. But a point here is, you've got $1.5 billion worth of cash flow, all right, but when you minus the net change in property, plant, and equipment being, CapEx, you've just got, just under, $1 billion worth of discounted cash flow, which is not bad. So overall, the financials of the company seem very stable. There's nothing of concern here. If I might add, it's actually quite good. So I'll move over to Seeking Alpha, and we'll just look at the dividend summary here. All right, so it's got a nice starting dividend yield of 3.9%, right, which is pretty good. So an annual payout of $5, and this is what you want to look for. So the 5-year compound annual growth rate is just under 15%. That's a very good growth rate. Companies like JEPI and SAHD hold 15 to 16%, and a regular sort of company, just the old average company, is looking at around 5%. Okay, so to have a nice 15% compound annual growth rate is really good. A dividend growth consistently of 12 years, okay, which is not too bad. It's not a dividend king or an aristocrat, but at least you can see here it's got some sort of consistency. Okay, every year they're paying out $1.25 per share, and they're a quarterly paying dividend company. All right, so moving over to the dividend history, so you can see they've actually been paying a dividend consistently for 18 years, and it was the most recently 12 of the most recent years that they've actually continued to grow that dividend. Without any sort of dividend cuts, which is really good. Okay, so if we move over to the dividend growth tab, okay, we can actually see which years and how much they've actually been increasing that dividend by. So 2015, okay, an increase of 37%. 2018, an increase of 19%. And for the most recent a couple of years, 2021 and 2022, it's just under 19%, which is just incredible. A regular sort of dividend paying company would increase their dividend every year by, like 5, maybe 7%. Okay, so just to have it sort of consistently of 18% is really good, and should be, the dividend investors out there should be really happy and keen to start investing into this company based off that. All right, so now moving into stake, and we just want to see how the company's been traveling over the last sort of 3 years. So back in 2020, it was trading at a low of $95. You fast forward to the high in 2022, it was sitting at $163. It's now currently sitting at $128 there. So it's not the lowest, it's not the highest. It's kind of sitting into that sort of that mid range, which could indicate like a good buying opportunity at a nice sort of low starting dividend yield of just 4% there, as you can see. So this could be a good opportunity to buy this company at a discount. But who knows? Anything can really happen from here. So overall, I mean, just looking at the fundamentals of the company and the dividend history, we've got good consistent revenues. The assets far outweigh the liabilities by $4 billion. It's got a good compound annual growth rate of just under 15% and a solid dividend history. We also know that there's a massive increase into sole traders and people who are starting their own businesses requiring their own sort of packaging as we're moving into a more online sort of space with our businesses. I think this is a strong company, and when you put all those fundamentals together with the dividend history, it's only showing good things. But that's the end of the video, guys. Let me know what your analysis of this company is, whether you would buy, whether you wouldn't, if there's any red flags. Let me know in the comments below. But yeah, make sure you thumbs up and subscribe to the channel. It really helps out, and I'll catch you next time.